So, you did it. You jumped into the stock market. That's awesome. But after the excitement of buying your first shares, there's usually a little thought that creeps into the back of your mind. Uh-oh, what am I supposed to do about taxes? Don't worry, you're in the right place. We're going to break it all down, nice and simple.
Here's what we're going to cover. First, we'll walk through the yearly timeline so you know what to expect and when. Then we'll get to the fun part, how your profits get taxed. After that, we'll actually look at the surprising bright side of taking a loss. We'll also touch on dividends and interest, and then wrap it all up with the key things you absolutely have to remember.
All right, first things first. Let's get a handle on the annual tax cycle. It's way less intimidating than it sounds, and it all revolves around that good old calendar year.
Okay, so here's the basic rhythm. On December 31st, midnight, everything for the year is locked in. Your brokerage takes a snapshot of all your trades, profits, and losses. Then, around mid-February, you'll get the most important piece of mail of the year from them. This document has everything you need to get your taxes filed by that April deadline.
And that document is called the Consolidated 1099. Seriously, think of it as your official report card for the IRS. It neatly packages everything up. It's got your gains and losses, any interest your cash earned, and any dividends you got paid. It's all right there in one place.
All right, let's get into the part you've been waiting for. What happens when your investments go up? This is where we need to talk about something called capital gains. Now, here is the single most important rule to remember about profits. You only pay tax on the profit, not the whole amount. So, like the example says, if you buy a stock for $100 and you sell it for $120, the IRS only cares about that $20 you made. That's your taxable gain.
Which, of course, leads to the big question, right? For that $20 profit, how much do you actually have to send to the government? Well, the answer is, it depends. And it depends on one very simple thing.
And that one thing is time. It all comes down to how long you held that stock. If you sold it within a year of buying it, that's called a short-term gain, and it gets taxed at whatever your normal income tax rate is. But if you hold on for more than 1 year, well, that's where the magic happens. It becomes a long-term capital gain, and you get a major tax break.
And I'm not kidding when I say a major break. Just look at this chart. For higher earners, the tax rate gets nearly cut in half. And for folks in the lower income brackets, look at that. It's 0%. That is not a typo. Holding an investment for more than a year is probably the single biggest game changer when it comes to taxes. But hang on, there's another super important rule. Let's say you bought a stock and it's gone to the moon. It's tripled in value. Guess how much tax you owe? 0. Nothing. Not a dime. That's because a profit only becomes taxable when you realize it, and that means hitting the sell button. As long as you're just holding on, it's an unrealized gain, and the IRS doesn't care yet. Okay, let's talk about the other side of the coin. Losing money is never fun. It happens to every investor. But believe it or not, when it comes to tax time, there's a pretty significant silver lining. It's all about turning those lemons into lemonade.
And honestly, this is the perfect way to think about it. The goal is never to lose money, obviously. But the tax code gives you a little something back if you do. You can use those losses to lower your tax bill.
And just like with gains, that same rule applies here. A loss doesn't exist for tax purposes until you sell the stock and realize it. So if you bought a stock, it's gone down, and you're just holding on, hoping for a comeback, there's no tax impact for that year. You have to sell it to make that loss official. So, how does this work? Well, the IRS has an order of operations. First, they make you use your losses to cancel out any gains you have. So if you lost $10,000 on one stock but made $10,000 on another, they wash each other out. Your net gain is 0. Perfect. But it gets even better if your losses are bigger than your gains. Because if you have leftover losses, you can use them to reduce your other income. I'm talking about the salary from your job. This directly lowers your overall tax bill. And the maximum you can deduct against your regular income in any single year is this magic number right here, $3,000. So you might be thinking, what if I have a really bad year and my net loss is like 10 grand? Do I just lose out on the rest of that deduction? Nope, not at all. You use $3,000 this year and the other $7,000, it carries forward. You can use it next year and the year after that until it's all used up. That value is never lost. Okay, so gains and losses are the main event, for sure. But there are a couple other ways your brokerage account can generate taxable income that you just need to be aware of. First up is interest.
If you have cash just sitting in your account, it might earn a little bit of interest. Super simple, that's taxed at your regular income rate. Then you have dividends. These are little payments that some companies send you just for owning their stock. Most are also taxed at your regular rate, but some are qualified. And that's your key word right there. If a dividend is qualified, you get to pay those awesome, lower, long-term capital gains rates on it.
Phew. Okay, that was a lot of information, I know. So let's just take a breath and boil it all down to the absolute must-remember highlights for any new investor.
Here's your cheat sheet. Number 1. Holding for more than 1 year is your superpower. It's the #1 way to lower your tax bill on a winning investment. 2. Remember that magic number, $3,000. That's how much in net losses you can use to lower your regular income each year. 3. Keep an eye out for your Consolidated 1099 in February. It's your golden ticket to getting this all done right. And finally, and maybe most importantly, nothing happens. No gain, no loss until you sell.
See, understanding this stuff isn't just about filing paperwork once a year. It's about becoming a smarter, more strategic investor. It changes how you think. So the real question I want to leave you with is this. Now that you know the rules of the game, how is it going to change the way you play it?